If you're tired of overcomplicating your trades or bouncing between strategies that just don't work, this video is for you. Today, we're going to break down a complete and practical trading plan using the 25, 50, 100 EMA scalping strategy. A fast, reliable, and highly effective method designed to help you trade with clarity and precision. This isn't just another setup with fancy lines and no structure. You'll get a clear, step-by-step blueprint you can actually use. No fluff, no confusion, just a proven approach that works in real market conditions. And remember, here at ComLucro, we're all about smart, structured trading, so be sure to check out our content on the Wyckoff method and smart money concepts too. So let's jump right in and walk through each step of this powerful EMA scalping strategy and how to actually make it work for you. Before we dive into the strategy, let's take a quick moment to talk about moving averages and why they're so important for what we're about to do. Moving averages are powerful tools that help smooth out price data, making it easier to spot trends and understand the market's overall direction. For this strategy, we're specifically using exponential moving averages, or EMAs. What makes EMAs special is that they give more weight to recent price data, so you can react faster to market changes. Now, if you're not too familiar with moving averages or you want to learn more, I've got you covered. Check out our video called Technical Indicators: How to Use and Improve Your Trading Accuracy. In that video, we break down moving averages in detail along with other key indicators and tips to sharpen your trading skills. And to give you even more clarity on how trend detection works in practice, here's David Paul, an experienced trader who simplifies the whole idea of technical analysis down to its most powerful core.
What's the goal of technical analysis? Well, I define it as the study of trends and turning points. So I'm looking for a trend, and then I want some knowledge of when that trend is going to stop. So I look at price, and I look at momentum of the price. And I use a concept called divergence, where if a market is falling, and the momentum is rising. In other words, it's like you being in your car and you're slowing down. If you're in your car and you're slowing down, then there's a higher probability that you're going to stop and maybe turn than if you were speeding up. So if the price is falling and the momentum is increasing, then that means there's more downside to come. However, if the price is falling, but the momentum is slowing up, then there's a high probability of a turning point. And that's what's called normal divergence. Similarly, if the price is rising, but momentum is slowing up, then there's a chance that there's going to be a turn. In technical analysis, there's 1,000 indicators that measure the rate of change of price, momentum. They're all pretty much the same. There's things called rate of change, there's momentum itself, there's RSI, there's stochastics, there's MACD, there's a host of them.
That's a great foundation for what comes next. Now that you understand why EMAs matter and how they help identify trends and shifts in momentum, let's break down the strategy step by step. To follow along with this scalping strategy, here's what you need to do. Add 3 EMAs to your chart. If you're using TradingView, it's super easy. Just search for exponential moving average in the indicators menu and add 3 of them. Set the periods to 25, 50, and 100 and make sure your chart is set to a 5-minute time frame. This setup is crucial for the strategy to work. If you're on a different platform, don't worry, the process is pretty similar. Just look for the option to add exponential moving averages and set the same periods. To make things even clearer while you're following along, I recommend using a consistent color scheme for your EMAs. For example, use light green for the 25-period EMA, pick light red for the 50-period EMA, and go with cyan for the 100-period EMA. This color setup not only makes it easier to identify trends at a glance, but it also helps you stay organized as you apply the steps of the strategy. And here's something even better. To save you time and make this process even smoother, you can use our custom tool, the Exponential Moving Averages by ComLucro Indicator. It's available on TradingView, and it's designed to be flexible and easy to use. With this indicator, you can adjust the EMA lengths to any value you prefer. The default settings are 10, 20, 50, 100, and 200, but you can customize them however you like. Change the colors to suit your personal style or make trends easier to spot. Show or hide any of the EMAs with a simple checkbox so you can keep your chart clean and focus on what matters most. Adding this indicator is quick and straightforward. Once it's on your chart, you can adjust everything directly in the menu, giving you more time to analyze market trends and execute your trades with confidence. This flexibility makes it a powerful tool for any trading style, whether you're scalping or analyzing longer-term trends. So give it a try and see how it helps you streamline your setup and take your trading to the next level. Alright, so let's break this strategy down one step at a time. No rush, just nice and clear. First things first. Step 1. We've got to identify the trend. Before anything else, that's where the game begins. The first step is to determine the market trend. Look at the 25, 50, and 100 EMAs on your chart. To confirm a trend, all three EMAs must be aligned in the same direction and spaced apart. If they're sloping upward and separated, it's an uptrend. For a downtrend, they must slope downward and stay aligned in the same order. Avoid entering trades during ranging markets, where the EMAs are flat or crossing each other. A clear trend is essential for this strategy to work effectively. Alright, now let's move on. Step 2. Spotting the entry signal. Once you've identified a trend, it's time to look for an entry signal. Here's how it works. For a buy trade, the price must pull back and close below the 25 or 50 EMA. Wait for the price to close back above the 25 EMA. This confirms your entry signal. Remember the golden rule. If the price touches or breaks below the 100 EMA during the setup, the trade is invalid, as this indicates a potential trend reversal. For a sell trade, the process is reversed. The price must pull back and close above the 25 or 50 EMA. Wait for the price to close back below the 25 EMA to confirm your entry. Alright, let's keep moving. Step 3. Planning the exit. Once you've entered the trade, it's crucial to plan your exit. Set your stop loss at the 50 EMA for tighter risk management or at the 100 EMA for a more conservative approach. Your profit target should be 1.5 to 2 times the distance of your stop loss for a solid risk-to-reward ratio. To further protect your profits, consider using a trailing stop aligned with the 50 EMA. This allows you to lock in gains as the price moves in your favor while giving the trade room to breathe. So, here's how this looks in action. Imagine an uptrend where all three EMAs are sloping upward and the candles are above them. You're waiting for the price to pull back and close below the 25 or 50 EMA. Once it closes back above the 25 EMA, you enter a buy position. Your stop loss is set at the 50 EMA and your profit target is set at 1.5 times the stop loss distance. As the price rises, it hits your profit target, resulting in a successful trade. Finally, let's take a look at how this works in a downtrend. In a downtrend, the process is reversed. The EMAs slope downward and the candles stay below them. Wait for the price to pull back and close above the 25 or 50 EMA, then close back below the 25 EMA to enter a sell position. Use the same stop loss and profit target rules, and as the price drops, you achieve another successful trade. In conclusion, mastering this 25 to 50 to 100 EMA scalping strategy can significantly enhance your trading efficiency in trending markets. By understanding how to identify trends, pinpoint entry signals, and plan your exits, you'll trade with more confidence and consistency. But strategy alone isn't enough. Without the right mindset, even the best setups fall short. That's why discipline needs to be part of your edge. And no one puts it more clearly than Darren J. Miller, a trader and psychologist who understands the mental side of performance like few others.
I think if I were forced to choose one, probably be self-discipline. I'd focus on the 5-factor model of personality, and one of the factors is conscientiousness. And inside conscientiousness, you have 6 facets, one of which is self-discipline. And not only in trading, but in life in general, self-discipline is key to being successful at anything. If it's a diet, how many of us have tried to lose weight? It boils down to self-discipline. Are you able to monitor your calorie intake, things like that? When it comes to trading, you can have the best laid plan, you can have the perfect setup, but if you're not disciplined, you're not going to be successful. You may take too much risk, you may trade at an inopportune time. So being able to monitor yourself, to have the discipline to say, you know what, I woke up late today, I'm not quite sure why the markets are where they are. I need to take a break, fire yourself, so to speak. Come back the next day, spend that day doing some research, some homework, maybe read, catch up on other things that are going on around, and show that discipline, and be able to make a more informed decision the next day.
Discipline is what turns a strategy into a system and a trader into a professional. Keep that in mind as you move into the next chapter of your journey. If this episode helped you see inducement and liquidity in a new light, don't stop here. The rest of the series dives deeper into key concepts like fair value gap, change of character, break of structure, advanced entry tactics, and trade management. Each video is designed to give you more clarity, more control, and a sustainable edge in the market. So remember, stay focused, stay disciplined, and let's keep moving forward, one high probability setup at a time. I hope you enjoyed today's video. If you found the content helpful or engaging, please give it a like, as this helps the video reach more traders like you. And don't forget to subscribe to the channel and turn on notifications so you never miss our latest insights on the markets and practical trading strategies. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Now, if you want to go even deeper and get access to exclusive content, early video releases, and extra tools to support your journey, consider becoming a member of the ComLucro Trader community right here on YouTube.